Good evening, everybody. Welcome back to Strongman Personal Finance. My name is Christopher Bell. I'm a certified public accountant. I'm a long-term Bucklehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. It's so expensive. It's like the same price as Meet Kevin's course, and it has much better value. And we're going to do some analysis on General Motors. Now, if you've been looking at the stock and you've thought to yourself, I'm really low on cash because I'm saving cash to max my tax advantage account in 2022. But perhaps I can go sell my ANUS down at the docks or down at the stables. I hear there's a lot of demand down at the stables. Perhaps I can go auction my ANUS down at the stables to afford some extra money to buy GM stock. Well, guess what? Before you make that decision to sell your butt for General Motors stock, I want you to actually do some fundamental analysis. It's very important to do the math to see if the stock is actually a good deal right now. Now, I know cars are the future, electric cars are the future, and GM says they're going to make electric cars. And it's probably a better deal than Tesla stock right now. But we need to actually look at the numbers and see. So let's see what GM wants to do. They have some plans. General Motors details plan to double its revenue. Ooh. I'm going to double my revenue, and if I say it, it's true. Drive even higher margins. Unlocking growth in EVs through Ultium hardware platform. Plan to double annual revenues and expand EBIT adjusted margins to 12 to 14%. So they want to double their revenue, I believe, they want to double it by 2030. So in 10 years, they want to double their revenue. What compounded annual growth rate is that, you may ask? 7% per year. They're claiming they're going to grow their revenues by 7% per year compounded, which will double their revenue in the next 10 years by 2030. Let's see if that's actually feasible. So what I did is I went on returnoninvestedcapital.ai. I think that's what that stands for. I could be totally wrong. And I looked up General Motors. And here we have it. General Motors Company. New York Stock Exchange, ticker symbol, GM. Recent price, $61.53. Well, that's a lower price than Tesla, so it's cheaper, right? Wrong. Well, it is cheaper, but not for that reason. PE ratio, 8. It's got a low PE. That means it must be a good buy, right? PEG, a PEG ratio, negative 1.43. That's interesting. Usually I see positive PEG ratios. Wonder what's causing that. And PE ratio relative to the S&P. So if you're looking at this, you'd say, well, the PE's low, and that's a value stock, right? Because it's a low PE, and that's what you do for value stocks. Well, that's not necessarily the case. So I went ahead and exported this to Excel, and I pasted this into my financial model. So here we have all the information. This is not Square, it's GM. Sue me if you don't like it. GM. GG. What's wrong with this? GM. So here's all the financial data for GM, and I actually have some calculations at the bottom of this. This goes from 2012 all the way to 2021. Now let's look at some very important ratios which will help us determine our inputs for our model. Free cash flow is a percentage of sales. Now going all the way back to 2012, 1%, 1%, negative 1%. Wow, they seem to be investing a lot. Negative 7%, negative 7, negative 7, negative 7, negative 6, negative 9. So, if you want to value this company, I don't think you can really do that with free cash flow. You have to look at net income and net income by itself because you have negative free cash flow going back for the last freaking 10 years for this company. Wow, very impressed so far. Net income ratio, 4%, 3%, 2%, 6%, 5%, negative 2%, 5%, 4%, and 8.5%. But that's over the most recent 12 months. That could probably be a fluke, unless they actually are changing their ways. I don't know. Revenue growth. Pretty freaking slow. Look at this. 2%, 0.3%, negative 2%, 9%. Oh, good year. Then negative 12, 1%, negative 6, negative 4. Now, if I was looking at this, I would think this is a potentially dying company. It's still a massive company, but it could potentially be on the road to extinction. Not because of Tesla, but there just seems to be a lot of competition in the auto industry. They've had negative cash flow, negative free cash flow for a long time. And their revenue's been declining pretty significantly. And they're a low margin business. On top of that, share change. So they actually, they were buying back shares, but now they've slowly issued shares. But it's not crazy dilution. Now, I don't know if they're going to issue a lot of shares going into the future because they need to finance their expansion into EVs because they already have a lot of debt. Debt to equity ratio. Here's one thing that worried me. So you take debt, your total long-term liabilities divided by, or total liabilities divided by your equity. That gives you your debt to equity ratio. The higher the number, the more indebted the company is. So going back to 2012, 3, 2.8, 4, 3.8, 4, 5, 4.75, 4.3, 4.12. So it looks like they're slowly actually chipping away at their debt. But that's still pretty high freaking debt to equity ratio. But at least it's trending downwards, which is not a bad thing. And then I added the current ratio, which is current assets divided by current liabilities. You want it generally to be over 1, which means that the company is able to pay its short-term debts with short-term assets. But that's not always the whole picture, but it's helpful, all right? 1.3, 1. Blah, 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 blah. So really, I mean, they've been hovering around 1, and I don't think they're going to go out of business anytime soon. I'm not worried about General Motors going out of business anytime soon. Anyway, so let's update this to GM. Share price 61.53. And let's start throwing some assumptions in here. So let's say, worst case, GM continues to decline as a company. I'll say -3, -4% in revenue growth. Because if you look, I mean, the last couple of years, it's been -6, -4. I mean, I think -4 was a reasonable assumption for a slowly dying company. Doesn't mean that you can't still get value out of it with negative revenues, but it's possible. And then we'll say middle assumption, 1% revenue growth. And high, just to be optimistic, if they actually meet their revenue growth rates, which they claimed they're going to do, 7%. Share change. I think they're going to be potentially issuing shares. So we'll do, let's say, worst case, they issue 1.5%. Then they do, 0.75%. And then they do, best case, they don't issue any shares. Profit margin. Now, here's where it gets tricky. Now, their profit margin's kind of all over the place. 5, 4, 8. I think an approximate profit margin is going to be between 3, maybe 4, and 6 or 7%. So let's say 3.5, 5.5, and 7.5. Okay. Oops. Had a mistake there. Thought I had a problem with my formulas. No. All right. Free cash flow is a percentage of revenues. I'm not even going to freaking do that because they're just all negative. You can't even freaking measure it that way. All right. Price to earnings ratio. This is already a low PE company. So, I mean, God, it could be as low as 3, 5, and 7. It has a PE of 8 right now. Now, if you want to get a 15% return, it is currently a buy at this price, very roughly, if you believe their revenue is going to grow 7% in the next 10 years, okay? So what they're claiming they're going to do, it actually looks like that's perfectly priced into the stock to get a 15% return. But if you think revenue is going to be flat, or barely, break even, or maybe there's no growth, then heck no, this is massively overvalued. If you think revenue is going to decline, this is also massively overvalued. So it looks like the price is freaking, set perfectly for an 18% or 15% return if you believe these high assumptions, which I don't believe them in the slightest. I don't believe that crap in the slightest. I think best case, their revenue is going to grow 3% with the rate of inflation. And if that's the case, it's still not a buy, okay? If you want to get a lower return, you can potentially think about investing. Let's say you do 10%. If my freaking keyboard actually works. God, I need to get a new freaking keyboard. All I have is expenses. If you want a 100% return, if you want a 10% return, okay, maybe it's a buy. If you believe these high assumptions, but I don't. So overall, my verdict is I want to wait and see with General Motors. I think it's going to survive. I don't know how well it's going to do because there's so many other competitors entering the EV space that I really just can't tell how well they're going to come out in the future. This stock could be down or flat for a long, long time until we actually determine the future winner of the EV race. So that's my thoughts. I am rating GM not a buy. Not in the slightest, okay? But you do whatever you freaking want. It's your life and your money. That's it. Like, subscribe, tell your friends about me. Y'all have a wonderful night. Cheers!